Hi, I'm Kezia Samuel, Chief Market Strategist at AssetMark, and welcome to Mark-to-Markets Beyond the Numbers. The first half of 2026 tested investors with geopolitical tensions, changing expectations for interest rates, and shifting market leadership. Despite that uncertainty, markets proved remarkably resilient. Let's start with how markets performed before looking at what drove those returns. Now, despite periods of volatility, most major asset classes finished the first half of the year with positive returns. U.S. stocks rebounded strongly, international markets also delivered solid gains, and diversified portfolios continued to benefit from staying invested. But the bigger story isn't the returns themselves, it's what's changed underneath the surface. One reason markets have remained resilient is that returns have been supported by stronger corporate earnings. As the chart on the left shows, most of the S&P 500's gains came from earnings growth rather than higher valuations, a healthy foundation for market returns. While AI remains the market's leading investment theme, the winners have changed. Earlier in the cycle, investors focused on large technology companies investing heavily in AI. Today, that leadership has shifted towards the companies building the infrastructure behind it, particularly semiconductor manufacturers and chip equipment companies. That shift is a good reminder that market leadership is always evolving. This heat map illustrates that point well. Each column represents a different year, with green showing the strongest performing asset classes and red the weakest. Looking across the past few years, leadership has consistently rotated. Large growth stocks, the Magnificent Seven, small caps, commodities, and emerging markets have all had their turn leading the market. The takeaway is simple. Today's winners won't necessarily be tomorrow's winners, which is why diversification remains so important. Emerging markets are a great example of how leadership has evolved. In the past, emerging market performance was often associated with commodities or traditional manufacturing. Today, it's increasingly an AI story. Companies like Taiwan Semiconductor, Samsung, and SK Hynix have become key suppliers to that advanced chip powering AI, helping drive much of this year's strong performance. Now, while emerging markets have become an important part of the AI investment story, leadership within this asset class has also become more concentrated. Another major force shaping markets this year has been the changing expectation for interest rates. Earlier this year, investors expected several Federal Reserve rate cuts. Today, markets expect interest rates to remain higher for longer. While that has created some pressure on bond prices, it also pushed yields higher, giving investors an opportunity to earn more income from high-quality bonds than they've seen in years past. That same interest rate expectation has also influenced other parts of the market. Gold, for example, actually pulled back during the second quarter despite ongoing geopolitical uncertainty. Expectations for that higher interest rate strengthened the dollar and reduced the demand for gold, showing how different asset classes often respond to the same market forces. The first half of this year reminds us that while market leadership may change, maintaining a well-diversified portfolio remains one of the best ways to navigate an evolving market. Thanks for joining us in this quarter's Beyond the Numbers. For more insights on what to expect for the remainder of the year, check out the 2026 Mid-Year Outlook Special Edition of Mark to Markets.